Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, a European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into today's discussion, I'd just like to remind you, if you like today's episode, to hit the like button and don't forget to subscribe so you can get our latest episodes as soon as they're available. Okay, another big week this week. I feel like I start the podcast that way every week, but it really was a big week this week. Most notably with the Fed. We're recording this on Thursday, so it was the Fed last night for us in the UK. So Jan, why don't you tell us, I guess, what we learned from the Fed yesterday and what the kind of main takeaways were?
I mean, the Fed yesterday came off a lot stronger than what most people expected, and we saw the market reaction. So I'll just summarize around the three main points that I think are worth discussing and we'll be discussing over the next couple of months: the rate hikes, the timing of rate hikes, balance sheet reduction, and the outlook for inflation. On rate hikes, Powell basically confirmed for March. As we expected, they adjusted a statement saying that they're phasing out asset purchases and they expect it will soon be appropriate to raise the target range. And during the press conference, he also said that he sees March as the most likely date. Headlines reported that Powell sees every meeting live. It wasn't necessarily as a live meeting for where they could hike interest rates. I wouldn't say he said exactly that. It was a little bit taken out of context. He just didn't deny it. So I guess it was admission through omission. But we now have, and we'll come back to our forecast, but we now have off cycles, so non-quarterly meetings as hikes in too. And more importantly, he was very, very adamant that the economy and particularly the labor market is very strong, running full steam. So he didn't see that rate hikes, even more than what we saw at the December forecast, would hurt the labor market. So that's one. We're getting March confirmed and possibly more than 4 this year. On balance sheet reduction, something that was slightly surprising, they issued a set of principles on how they're planning to do that. Those weren't necessarily, this wasn't a new bit of information, but it showed that they're making quick strides in starting the balance sheet reduction. This is not an addendum where they kind of talk about how they're going to do it, or an implementation note saying we're about to start with these caps, but rather it's just saying the Fed funds are a main way of controlling monetary policy, but we will start running down the balance sheet after we have begun the process of raising interest rates. So that means May or June, latest in our view now, doesn't really make a difference. Powell said his guess is that it will take at least another meeting to debate the details around the balance sheet normalization before they make an announcement. And like I said, I don't think it makes a big difference if it's May or June, because he also mentioned they would go concurrently. He received a question asking, well, how many rate hikes does one X amount of QT replace quantitative tightening? And he was pretty much saying, we don't look at them as equivalent. We don't have that much info. Only one experience of tightening before, of running down balance sheet before. So they're not really comparable, but we're going to keep them going side by side. We have to agree with that view. I mean, there's different metrics that try to estimate the equivalency, but it's just a lot of event studies, and I think they are likely to go side by side. So we could see QT announcement at the same meeting as a hike, or in between meetings, but we're likely to see it now in the first half of this year. And finally, in inflation, again, now it's not even transitory. Now it's about persistency of inflation. That's the new theme. And he did say that fiscal policy will pull back a little bit, so the impulse comes back, which means inflationary pressure from the supply side should go down. He does expect supply chain pressures to go well into next year. So there's a lot of risk to the upside. And his forecasts, when asked, he said his core PCE forecasts, he would have adjusted them, I think he said by a couple of tenths of a basis point. So like I think 30 basis points higher compared to the December forecast. So the outlook has turned a little grimmer compared to December. So those are the core themes that we're going to be looking forward. Hikes are coming, more front loaded, balance sheets happening first half of this year, and inflation outlook is more uncertain with risk to the upside.
So Has this left you with a kind of changed view of how many hikes we're getting, the timing for quantitative tightening, QT this year? What's your kind of Fed call now then for this year and next year, I suppose?
We pulled our forecast a little bit earlier. We haven't changed our terminal rate expectation, so around 2.5%. But now we think there's going to be five hikes this year, starting with March in 25 basis point increments. So like starting in March, then we have May, June, September, and then December. That before we had quarterly starting March, June, September. And we, in our previous forecast, we skipped one of the meetings for QT announcement. So really it would have been March, June, September QT and December hikes. Now it's 5 hikes, and we think that they're going to announce QT in May, possibly in June. It's not really a strong conviction view, but like I said, it doesn't make a difference. They're going to go side by side.
You alluded to it a little bit then, but there's been a quite strong debate or an increasing debate about whether they go 25 basis points or 50 basis points in March. You have told us now that, that you sit on the 25 basis point side of that fence. What's your reasoning for thinking they do just 125 rather, or an additional 25 rather than 50 in one go?
This is one of those things I have to admit that I thought the 50 basis points was out of the picture when market was pricing a little bit higher. My view was to just fade that. I still don't think we're going to get 50 basis point hikes because, and the main reason I think that is, Powell mentioned, and there was he subtly said that they're happy with the way markets are reacting to the communications by the FOMC officials, and he believes that those channels are generally working. So I think the messaging was not there yet to indicate that they're going to go for more than 25 basis points. What made me a little bit more hesitant, and I think it's closer call than it was 24 hours ago, is he was asked twice during the press conference of the potential for 50 basis point hikes, and he just didn't. He said, we haven't made a decision, but immediately right after that, both answers were followed by, the economy is very strong, inflation is running way above target, unemployment is where we want it to be. And those are all, the circumstances are all better than where we were in 2015, 16, 17. And so he says we haven't made a decision, but look at all this data and it's different this time. So it's possible. For now, we're sticking to 25 basis point increments in faster delivery as opposed to larger and more spread out. But it definitely is more likely than it was yesterday, I think.
Okay, fair enough. And just to wrap the discussion up on the US and the Fed then, how does this leave your, I guess, yield view and your curve view? One of the big arguments we've talked about a lot of times before on this podcast is that you're expecting, higher yields across the curve, but led by the belly, and so a kind of 5s, 30s flattening. I take it, given the fact that you still see a higher terminal rate than the market's looking for, you're still on board with those views.
Yeah, we're still on board with those views. And like I mentioned, market is looking for a front-loaded cycle, just like we are, but they expect the cycle to not abruptly, but stop short where we think it will be in 2023. This morning when I checked, the entire 2023 pricing still stopped short of 7 hikes. And if delivered the way we think, it would be 9. So even things like 2 stands, perhaps in forward space, could make sense. But our core view remains of short belly, 5s, 30s flatteners, just the fact that we think Fed continues more and more, doesn't just stop next year.
Okay, that makes sense. Thank you. Over to the UK then, because the central bank focus will shift forwards now to the UK and Europe with the Bank of England and the ECB next week. What are we expecting from the Bank of England next week? And I guess particularly with regard to the bank rate, because that's where we're going to see the most movement probably.
In the UK, we definitely expect 25 basis points of an increase at the upcoming meeting. So what the BOE signaled in December was significant. And the signaling was really, that they need to act against inflation despite Omicron. This is why we got a hike in December 2021. So we do expect another 25 basis points at this meeting. At the same time, we expect the 28 billion of QE that mature not to be reinvested. And this is significant. So that not reinvestment means basically that easing that was otherwise supposed to happen, that does not take place. And this by itself is a form of tightening. So tightening comes from two sides. One is the bank rate, and the other point is really a reduction in the stock of QE.
And I guess given what we've just heard from Jan and a more hawkish than expected Fed, how does that communication kind of influence the Bank of England and how you're thinking about them going into next week?
Yeah, central banks, they definitely pay attention to each other, and it's very notable that in Catherine Mann's speech, the very last section talked about global central bank moves, and what we saw there is really that we've got an indication that, well, if the Fed they move faster, then other central banks probably have to follow. And in the UK, this means that probably the UK will have to follow the path that is being indicated by the Fed. So yeah, we do expect that to signal more hikes. Right now in the UK, we price almost 1.4% of the bank rate by the end of the year. So there is very fast tightening being priced. So we talk about 4 hikes and something, which is a little bit less than the Fed. But in any case, we talk about quite a lot of tightening that is in the process of being priced in the UK.
So sticking with, I guess, the comparison for the Fed, because obviously, when it comes to the US and the UK a little bit differently to the ECB, we're now starting to think about quantitative tightening, and well, we've been thinking about it for a while, really. And you mentioned earlier about this bond not being matured after the February hike. So what are you thinking, I guess, beyond that in terms of balance sheet reduction for the Bank of England?
So the non-reinvestment obviously is significant, and we have around 37 billion of gilts that will mature in this year, and then in the coming years, this number becomes bigger. We think that at some point active sales will be discussed as a topic. We think that active sales, if they were to happen, they will be confined to a small number, call it up to 30 billion a year. And probably the BOE, they will have to do that through short-dated maturity. So they will have to find a way how to do that so that it does not influence the market. As it stands, what we think is that any discussion that indicates, selling of gilts, if it comes to long gilts, I think that this is dangerous in the sense of it would create a lot of volatility, and this is why we do not think that this will happen anytime soon. So it will be a topic of discussion. We can envision some reduction of the stock of QE through more active sales. And if the market is right, by mid of the year, call it Q3 around August, will be close to or at 1%. So then the topic of active sales will be discussed. But in our view, the important point is that if that is to happen, also it will have to happen in a smooth and predictable way so that it does not create market turbulence.
Okay, moving away from central banks just slightly then, because it's also been a very busy week this week in terms of politics in the UK. The market seems to have kind of brushed off any political concerns this week. How are you really thinking about, the potential for Boris Johnson resignation, perhaps even early elections? How are you thinking about that, I guess, through the lens of gilts and potential gilt issuance, et cetera, et cetera?
I think the UK market has been a political market, and either we like it or hate it. When we take the last 3 years, Brexit, well, in politics, they have driven gilt valuations, right? If we are to have some move when it comes to the leadership of the Conservative Party, the question is, does it lead to, a new prime minister who may want to please voters, in which case we talk about more fiscal spending, because I don't think that a lot of voters are so much in favor of austerity. So maybe do we talk about more spending, maybe more infrastructure work, maybe some giveaways, right? This is something that it happens pre-elections. And this is something that it could be a downside for gilts, because if you think about it, we talk about gilts in an environment where we will have more issuance. So the DMO, they've penciled 215 billion of gilts in the next financial year. If we talk about, some more fiscal laxity, then we talk about even higher numbers. We talk about not QE, we talk about even active sales, and that all pushes rates higher. So we do think that for the first half, at least of the year, there is a propensity for yields to be pushed higher. This is why we have a target of 1.35 for 10-year yields. And we also think that longer duration gilts, will suffer. We think that break-evens on the back end of the curve can widen in all those points. So yeah, I think that politics in this case, it can mean more issuance, and this will have to be translated into high rates, because now it is different to the past. Now political uncertainty does not mean that the BOE cuts rates, which is very different to 2019, 2020, and all those Brexit negotiations and potential hard Brexit. So yeah, I think we remain to see how this evolves, but definitely it will be quite exciting and with implications for the gilt market.
For sure. Lots to watch in the UK next week then. All right, back to central banks. This time over to Europe, because there's a lot of discussion in Europe at the moment that, there's a lot of concern around the ECB getting behind the curve, I guess, particularly with an eye to what the Fed are doing, what the Bank of England are doing. We're talking about the Fed potentially hiking 5 times this year, the Bank of England hiking 4 times maybe. And well, depending on your view, which I think we'll get into, perhaps the ECB not even hiking at all. So are you worried about the ECB getting behind the curve, Giles, or you're not as concerned as other market participants might be?
Well, it looks like the market's more concerned than me by now. I don't particularly have any problem with the notion that the ECB has to hike rates from next year onwards, right? But this year I still think it's a stretch to have any confidence that they will raise rates. But that's not what the market's saying. We have a reasonably high, in fact, significantly better than even's probability now priced in for a rate hike in December. So I think all the things that have to happen for us to get there, I think it's still too much of a challenge, to be honest with you.
So just picking up on what you said then about more than even's probability of a rate hike, by that I guess probability, it means you were thinking about that in terms of a 25 bip hike rather than a 10 bip hike, because as of today, a 10 basis point hike is fully priced by the end of the year. So I guess similarly to what I was asking Jan, where do you sit on this side of the debate, whether the ECB will go with 10 or 25 to begin with?
You're quite right to call me out on that, Imogen. I still think that 10 basis points would be a reasonable way for them to start. I mean, it has been years since the market has been faced with rising rates at the front end. And they were very cautious on the way down. You would say, okay, that's because they didn't know where the effective lower bound was, and so they had to take mini steps in that direction just to make sure that each little step wasn't going to be doing more harm than it did good. And I can understand people who say it's not the same when you go back up, because we know that rates sort of work in a certain way when they're going back up, right? Fine. And a few people have also pointed out that other central banks, notably the Riksbank, did 25 basis point steps. Now, no, I don't think there's any need for the ECB to hurry necessarily. And I mean, if they do 10 basis points, they could do 10 basis points a quarter, deliver 40 basis points in a year. That would be quite a lot in the context of interest rate expectations even now. If they want to do more, they could accelerate a little bit further on. I don't see the need for them to start like that, to be honest with you. I think that 10 basis points already sends a pretty strong signal that the cycle is turning. You get quite a lot of bang from that particular buck of spending, if you wish. Nonetheless, 25 basis points I suppose you can consider it. I mean, if you talk about the Riksbank, I mean, they did 25 basis points and then waited a year before doing another one. The market seems to be more like, well, 25 in December and maybe 25 again in 3 months later next March, right? And I think that is seriously pushing the bounds of what seems possible / likely.
Okay, so I take from that you then would push a bit against the current market pricing. But I guess the other discussion that we've been having is how much of this is really about the market actually expecting rate hikes, and how much of this is about some kind of pricing in of perhaps a sizable step in the amount of liquidity draining at the deposit rate. Particularly when we consider that a large proportion of TLTRO money may well be paid back as early as June this year. Is that liquidity effect? Is that what's going on here and causing this kind of shift in market pricing, or is it really all about rate hikes, do you think?
Right. Listen, I think this is something that people talk about much more than it really deserves, to be honest with you. We did some fairly in-depth analysis of this, not for the first time. I would stress it's not like we haven't been considering the possibility, but it's something that people want to talk about because obviously it's something that's happening this year, whereas rate hikes maybe they're not, right? And so and clearly there are reasons why the excess liquidity in the system might drop dramatically. I mean, in particular, there's a likelihood that banks will repay TLTRO money, which is money that was lent by the ECB to try to very, very advantageous rates in order to try to coax banks to encourage them to continue lending. So it was a sort of a carrot, if you like, for the right sorts of behavior for the banking system. And I think you could easily imagine the banks, once that very, very advantageous rate expires in June, we're paying quite a lot. I mean, and by quite a lot, we're talking financial markets numbers here. So we're talking hundreds of billions. I mean, we penciled in, as a rough guess, about 700 billion for that. So that would be. I mean, that's not trivial, even in the context of the money supply these days. And then there's probably more to come, right? I mean, so we figured, well, maybe 1 trillion, and they've also, there are all these sort of money market tweaks that they can do. There's one in particular called tiering, which I won't go into the technicalities of right now, but that would also tend to push front end rates higher. All told, we're talking 2 or 3 basis points from all of that, right? So if I now tell you that we've got 19 basis points priced in for an increase in front end rates by December, you can see most of what we're talking about here is rate hike expectations. And if anyone's looking at that and saying, no, it's more like 10 and 10, no, I'd strongly push back on
that. Okay, fair enough. So putting that all together then, what does that mean for next week's ECB meeting? They laid out this path for taper back in December. They told us that they would still be purchasing bonds up and through Q4 of 2022, which with their currency implies that they can't raise rates before net asset purchases have ended. So they're giving the strong signal that they won't raise rates in December of this year at the moment. Do you expect them to change that either next week or in the future?
No, not at all. I mean, they've been softening on the way that they talk about 2023 for some time now. I mean, I don't see any reason for them to change the guidance that they laid down in December at this point, to be honest with you. I mean, there is a lot more on. Well, I mean, there's been a lot of uncertainty for a long time, right? And it seems like we just substitute one uncertainty for another. So, we're not talking about Omicron on this podcast, at least. And I imagine that that's a conversation which is sort of we've all moved on from for the time being. Now we're talking about Russia, and that's potentially an inflation shock. Yes, fair enough. No, but I think that there's still enough of an uncertainty about how sticky all of this will be in Europe for them to just say, well, we'll continue down this path that we set out, and of course it'll be continuously reassessed. They'll remind us of that, but I don't think there's any need to change the broad shape of what they discussed 6 weeks ago.
Fair enough. So just to wrap up the discussion on Europe then, because it's also been a pretty volatile week in Italian debt. And that has been because we're still kind of awaiting the outcome of the presidential vote. They've now done 4 rounds of voting and still inconclusive, although rumor has it by tomorrow morning, Friday morning, there will, or parties are working towards coming to a conclusion. So by the time listeners listen to this, they may well have the results. But how are we thinking about the kind of direction of travel, I suppose, in terms of the discussion of potential candidates and parties when it comes to the Italian presidential election?
I'm actually quite interested in these rumors that you're hearing, Imogen. You're obviously very well connected. We're in a direct line to maybe some WhatsApp group of the Italian Parliament. Who knows? No, I'm just kidding. Of course.
I can't give away my secret.
Listen, I mean, we were joking earlier that maybe they need to just get it done so that they can go and have a weekend. But at the moment, it just seems like such great fun, and so yeah. Another long lunch to discuss it all before tomorrow seems clearly too tempting. How are we thinking about it? Well, as before, it's the basic question is how will the government look after this event, right? And if Draghi isn't leading that government, who is leading it? How much sort of collateral damage has been wrought in the whole sort of fight over who should be president or not, and therefore people will be looking for clues as in particular as to how likely it is that it all falls apart and we have new elections, because obviously the real kind of downside scenario that markets have in mind is that we have new elections this year, because of course everyone can see that the far right is doing so well in the polls. That's fairly remote sort of tail case in our opinion. But there are other questions about who is set up to continue where Draghi left off as prime minister, what's their credibility and so on, and to what extent should we weigh the benefit of Draghi being becoming president of the Republic for the long term, being able to shepherd the political process a little bit. I mean, clearly that would be a benefit, not enough in most people's eyes to offset the negatives of him leaving his current position. All right, I mean, listen, and then there's of course the fantasy outcome where Mattarella, who is the current president of the Republic, just stays on and waits for maybe steps down in a year's time or something, so that Draghi can finish his what he started as prime minister and then step up later. I mean, that shouldn't be ruled out. I think, I mean, the commentariat. Well, I mean, I don't know. How does it all add up? Uncertainty. I mean, there's a lot of uncertainty. BTPs have been selling off this week. I mean, it's hard to argue with that. I mean, it's all. I mean, it's probably sensible to be cautious. I quite like BTPs at their current level, of 140 and above. Your analysis on the political side, Imogen, and on the flows side for BTPs was all pretty supportive. And I think if you average over all the various scenarios and you go down into your decision tree and you look at all the probabilities and what you think each outcome might mean for the markets, I think that there's room to be more optimistic. And maybe just the last observation, I think it's worth bearing in mind that we are one of few optimists about Italian debt at the moment, as far as we can tell from our conversations. And if you know anything about markets, it's that when there's strong consensus, then maybe the smart place to be is on the other side of it.
All right. On that optimistic note, we'll finish this week's podcast there. Thank you all for joining me again this week. Lots to watch next week and for the next few weeks. So I'm sure it'll be another big week next week. But just a reminder to our listeners, if you like today's episode, please hit the like button to show your appreciation, and don't forget to subscribe so you can get the latest episode as soon as it's available. See you again next week.